Hello and welcome to today's video, which is called S&P 500 hanging on yields. It definitely is so much more after the FOMC, which made the 10-year yield to break the 433 resistance decisively without ever so much as looking back. So let me help you prepare for the upcoming week, the starting part. Remember that the daily analyses are the basis, so please make sure that you are reading them as opposed to relying on tweets simply. Twitter is for discussions, Telegram is for timely notifications, and premium Telegram channels is for the very best service that you as an intraday trader and investor can get on top of my quality daily analytics. So let me draw the big macro picture for you, how it changed as we entered this weekend. Friday, I anticipated a dead cat bounce that would be spurred by retreating yields. It did happen and was comparatively weak. It was also led by tech as opposed to cyclicals and value, and the shape of the daily candle, which you will see on the upcoming slide, shows just how weak it was in tenor. But back to Friday and the fundamental drivers. Weak data from Germany and France helped in pushing yields lower. US PMIs did not stand in the way, but what sank the markets during the US session were Bowden and especially daily, with the hawkish statements about 1 to 2 rate hikes and refusals to adjust the 2 percentage points inflation target. So we had seen 10-year yield retreat around 6 basis points to 4.44, but the picture, what I had told you already, it confirms weak prospects for the S&P 500 ahead. The correction is not over. I'm targeting figures in 4 to XX, reserved for subscribers. How I chart the prospects, I have one goal, one figure in mind, and I would be adjusting as to how realistic its reaching is in the end. What we have on the inflation front is rising oil prices, tight job market, which is not showing too many cracks yet. We have also seen dramatic dot plot moves. I wonder how as the next year progresses, how the Fed would be able to keep the hawkishness, but it's a pretty safe bet to count on November, probably. It's more likely than December to me, and February a rate hike, so meaning to still. We have heard from Powell quite contradictory statements about soft landing being on one hand the preferred scenario, yet on the other, recession was acknowledged as within the suite of potential outcomes, which is quite right given where I see the data coming. For now, we don't see a steepening yield curve, so there is no immediate danger of recession. It's still Goldilocks here. At the same time, due to sticky inflation that is approaching, that is for now 3%, but would be gradually, in my view, moving higher within this decade, over 3.5, maybe up to 4% with these, and I'm talking the say kind of median. For now, the Fed can count on pushing the year-on-year one really to 2 point something within within its all attempts, meaning the next wave. But whether it would have success keeping it there, because I frankly think that the period of disinflation is over and the greatest progress has been achieved, so we might quite as well walk off with 3% inflation CPI headline as it being just that trough. So we see it rising, and it's quite playing into the newfound hawkishness as opposed to data dependency. Recession is not over, is not near, even though transports, home builders and semiconductors are rolling over. It will take time to translate into broader real economy, but these are the three that usually get it first, and their charts are nothing appealing. So let's move into S&P 500 and the daily one. This is the weak upswing attempt that I talked about, and still on the retreating yields it closed at a new daily low. Progression of levels for 399 held, and I picked it up as short entry for the quality publications, so my premium subscribers are short this level, from this level, and for 385, and as well this level was used to close the profitable gainful call long one, second one on Friday within intraday signals, so I have played it both ways. So for 385 won't be overcome on Monday. My bias is sideways to slightly down Monday, not too much. But for 365 would definitely give in by turnaround Tuesday, and it would be tech leading to the downside. As much as it helped Friday, it would give way towards as we progress next week, which is seasonally among the worst ones, and then we have the entry to October, which is nothing appealing either. Now on to copper. The 365 almost worst case target has been reached already Thursday. I did not call for the upswing next day to last, and we saw Friday retreat even before 375, which I called as not being beaten. It's the same call in advance made for S&P 500 that for 399 would be the daily top, and it was. But when it comes to copper, 355 isn't that far away and would be reached relatively soon, meaning within weeks rather than within months. So real asset bulls have to count on stiff headwinds. I'm pretty sure you know me who I am. Beware of personators and make sure that you are talking really to me on Twitter and over email. And the obligatory disclaimer: have a nice weekend, and thank you for liking, commenting, subscribing.